Mr. Chairman. I've just been up with Secretary Salazar on several of the wells being drilled in North Dakota, and I tell you, it's extremely impressive. It's being carefully done. It's being professionally done. It's being done in an environmentally sensitive way. It's being done with extraordinary technology, and so we thank you for that as well. It's being done in I tell you, I don't think any one of us would go there and not come away impressed with the professionalism of how it's being conducted.
Thanks, Senator. I agree. In fact, the guy took me up one of the rigs in Montana. It was the same person that took you and Secretary Salazar off up a rig in North Dakota. If you could answer, if I might, just in one sentence, so what does it take to move that needle up to 5%? What's a 1%? What's a one-sentence answer of what it takes to move the needle to 5%?
Well, I think it can be done over time. You know, there's a lot of things we have to figure out the next step of enhanced oil recovery. That's going to play a big factor. Whether that's CO2, just normal secondary water flooding, or whatever it is. I mean, we've got to do that. That's going to move the needle on.
Thanks a lot, Senator Grassley.
As we begin to consider what comprehensive tax reform would look like, it's important to discuss goals, objectives, other than revenue collection, what the tax code should accomplish. We had testimony before our committee December 2011 on incentives for alternative energy. Ms. Sherlock of CRS notes, quote, "The income tax code has long been used as a policy tool for promoting U.S. energy priorities," end of quote. So it makes sense to consider whether or not our tax code of the future should further energy priorities. Those who want to isolate federal tax incentives for alternative energy and put them on a chopping block need to remember that the oil and gas industries have received massive permanent tax breaks for 100 years. In contrast, tax incentives for alternative energy have existed only a few decades and have always been temporary. These incentives first appeared in the 70s in direct response to oil crisis, and they helped to level the playing field for renewable resources. These incentives reduce the cost of capital investment for these fledgling industries that are not yet able to raise capital. Any argument made for eliminating renewable energy tax incentives is intellectually dishonest if it doesn't include a review of all energy tax incentives. Those opposed to incentives for alternative energy often fail to consider that a key reason to support renewable energy resources should be energy independence. The United States spends more than $400 billion each year importing oil. Now more than ever, the United States needs to ramp up domestic production of traditional energy, including oil, natural gas, coal, and expand alternative fuels and renewable energies, including all of them, and I won't name them because you know them. American imports almost 50%, I think it's a little bit less than 50% now of our oil. The U.S. Treasury pays out an average of $84 billion a year to defend shipping lanes to bring that oil here. These costs are never included in the discussion of cost effectiveness of tax incentives for oil and gas as compared to alternative energy. For sure, we need a tax system that is less complicated, fairer, and will make us more competitive in the global economy. However, there is a long history of using the tax code to promote energy policy, starting with intangible drilling costs and percentage depreciation provisions that are almost 100 years old. Experts in favor of these provisions argue that these provisions are not tax expenditures because they just represent ordinary business expenses and are similar to research and development. Yet the expensing of research and development costs and the intangible drilling costs are exceptions to the rule that such expenses should be capitalized and deducted over years. It seems the primary benefit of intangible drilling costs provisions is that it provides more cash for additional drilling operations, which results in more jobs. Retaining this provision then would seem to indicate that the tax code should play a role in our energy. So, to Senator Nichols and to Mr. Ham, does this conflict with the key objectives of tax reform to lower the rates and broaden the base? Wouldn't lower tax rates also provide more cash for additional exploring and drilling? And also, if the R&D and accelerated depreciation provisions are reviewed in the context of tax reform, do you agree that intangible drilling costs and percentage depletion provision should also be reviewed.
Senator Grassley, you haven't changed a bit. I remember having this debate for about the last 30 years. Couple comments. One, intangible drilling costs is expensing an out-of-pocket business expense. That's wages. You compared it to R&D. R&D is a credit. There's a big difference. R&D credit is dollar for dollar off your income tax, and the other one is a deduction for an out-of-pocket expense, wages. And I mentioned earlier before you arrived, I think for tax simplicity, you should allow every business to be able to expense certainly its wages. So I don't compare the two. I'm all in favor of putting basically everything on the table. It's exciting to think what you all are getting ready to do in very significant tax reform, and you should put everything on the table. But if you don't allow industries to expense their out-of-pocket expenses, as Harold Hamm said, you're going to have some real negative consequences. You won't have $2 gas. So I don't think this committee or Congress wants to do something that's going to have adverse economic impact. This happens to be the shale gas revolution as well as the oil revolution is one of the best things that's happened in this country economically in years. Congress doesn't want to mess it up. But I think you ought to look at every credit, because that is any credit is by nature, it's Congress saying we think this is even more valuable than the dollar you spend. You spend $1 and we're going to reduce your taxes by $1. So I'm all in favor of putting a lot of credits and deductions and tax exempts. You've got a lot of tax exempts that aren't taxed. Tax them. Tax everything once. You broaden the scope a bunch by doing so.
Mr. Hamm.
I agree. We, capitalize all the tubers, all the hardware out there. We capitalize all of that. We do write off the wages in regard to drilling and the deductibles in that regard. And it is a provision that encourages new exploration. And we need to look at down the road, what's going to happen down the road. Right now, we're using 91 million barrels of oil per day. Here in the U.S., we're producing about 10%. If you add to the chart the petroleum liquids, to that chart, we're at about 9 million barrels a day. So we're producing about 10% of our petroleum needs today. And that's estimated to be going up by 2035, 30% more to 112 million barrels. If we're going to produce our part of that in the future, we're going to have incentives like we have in place to do that.
Thank you, Senator. Senator Bingaman.
Thank you all for being here. And first, I congratulate Mr. Hamm and all those in the industry who have been so successful at increasing production. I think it is a good thing for our economy. Obviously, it's strengthening our economy. I've always thought that there are three primary goals that we have as a country with regard to energy. One is we want to have an ample supply at reasonable cost. Second, we want to have diverse sources of energy so that we're not dependent upon any one source. And third, we want to have an energy policy that does the least damage to the environment, does the least damage to the health of the citizenry. And so those are the three goals that we've got out there. Now, on tax expenditures, I know there's a lot of talk about reducing tax expenditures, and strong arguments have been made as to why those that relate to the oil and gas industry, at least the intangible drilling costs, ought to be maintained. I gather those Senator Nichols' view is we ought to repeal Section 199 for everybody, not just for the oil and gas industry.
I would think when you're doing corporate reform, having a uniform corporate rate, not a lower rate for manufacturers, would make sense. That's what I argued when I was on the committee, and I haven't changed my position.
Yeah, one of the things that's complicated our discussion of energy tax expenditures is that we have some that were adopted prior to the Budget Act of 1974, and we have others that have been adopted since the Budget Act. And by and large, those that were adopted prior to the Budget Act, which relate to the oil and gas industry, are permanent parts of the tax code. Those that have been adopted since the Budget Act are very limited in time in most cases, and they keep expiring. And those that relate to renewable energy have expired and come back, and we put them in place again, and then we let them expire again. I'd just be interested in the panel's view as to whether, whatever we do with these tax expenditures, would it make good sense? It seems to me it would make good sense to put them all on an equal playing field in terms of their permanence. And whatever we decide makes sense for the wind energy sector. If the production tax credit or some lesser version of the production tax credit ought to be a part of our tax code, then we ought to put it in place and leave it there for a while, just as the intangible drilling cost provisions relate to oil and gas production are a permanent part of the tax code. I don't know, Dr. Jorgensen, did you have a thought on any of that?
Well, as I said in response to Chairman Baucus, I think we need to focus on the environmental issues that really count, Senator. And those issues have to do with the utilization of energy. They don't have to do with energy technology. There's something that hasn't been mentioned that I think we need to focus on. Senator Baucus, I think, alluded to this, but let's put it front and center. In December 1998, I'm reading from a publication of the Energy Information Administration, the cost of a barrel of oil in Cushing, Oklahoma, this is West Texas Intermediate, the spot price, FOB, was $11.35. In April of this year, which is the last year for which we have data, April of 2012, that number was $103.32, 7 times greater. We have had an energy price crisis. You're all familiar with that. Everybody here has lived through this. That peaked with the price of June 2008, again, Cushing, Oklahoma, West Texas Intermediate, of $133.88. Now, what is the difference between this experience and our previous experience? These prices have not declined. In 73, it was followed by a price collapse. In 79, it was followed by a price collapse. In 81, it was followed by a price collapse. This has not happened. Something has changed in the world petroleum markets. These prices are permanently higher. This is the basis for the incentives that are driving the Bakken. You can talk all you like about tax incentives, and I'm not against treating these symmetrically with every other form of production. I'm talking about oil and natural gas. But the point is that once you do treat them symmetrically, you've got to reckon with the fact that we have seen a sea change in the world petroleum market. We have prices that are 7 times as high as they were as recently as 1998. That is the most relevant fact about incentives that we're here to discuss.
Could I,